Okay, you guys, in today's video, we're going to be talking about a bunch of reasons that you might not be able to qualify for your mortgage, especially if you do these in the middle of a home purchase. Hi, everyone. I'm Katie Evans, owner and lead agent of the Living 48 real estate team, and I'd like to welcome you back to another one of our video blogs, our vlogs. So today I am going to review with you guys 9 things, and this isn't all of them, but these are the big ones that could keep you from qualifying for a mortgage. So to give credit where credit is due, I wanted to let you know that I got these ideas from a website called The Motley Fool. And the article's name is These 9 Things May Keep You from Getting a Mortgage, The Motley Fool. All right, so credit has been given where credit is due. These ideas came from an article on their website. The first thing that could keep you from getting a mortgage, qualifying for a mortgage, being able to complete a mortgage, is going to be your credit score. So ladies and gentlemen, FHA loans cater to lower credit scores, but your credit score is going to be an important factor. So we would like to see it in the mid-7s if at all possible, or higher. But there are loans that will cater to lower credit scores. However, you will have a higher interest rate. So that is going to be something that you're going to want to discuss with a lender. Where does your credit score need to be to even qualify for a mortgage loan? All right, the second thing that is going to be a deal breaker for you getting a mortgage, if we don't take care of it, are going to be black marks on your credit report. Don't try and hide anything. It will come out eventually, and it would be horrible for it to come out right before we close on a house. So make sure we take care of all the black marks on your credit report. Number 3 that could keep you from being able to get a mortgage loan is going to be your income. Yeah, you have to have enough money. You have to have a job that will allow you to make the mortgage payments. And so that is a big deal. Number 4, excessive debts, okay? So your income needs to be at a certain level, but your debts also need to be at a certain level. So there's what's called a debt to income ratio that lenders look at. So your debts are also going to play in. Now, a lot of times your lender will say, hey, if you pay off this debt, you can qualify for this interest rate, or if you do this, we can get your credit score to here, or this, that, and the other. So they can give you some guidance on what you can do to bring all those numbers to exactly where they want them to be. But please note that, credit cards, your car loans, your other just miscellaneous debts that are out there. Most lenders are looking at you having a DTI, debt to income. So if you want to sound really smart, DTI, debt to income ratio of 36% or less. All right, number 5, your employment history. Lender wants to see that you have a good, solid, steady stream of employment, that you'll be able to make your payments, that you aren't a job bouncer, those kinds of things. So just know that you're going to need to be in the same field of employment for probably about 2 years. And they don't want to see excessive gaps in employment. So a lot of stuff can be overcome with just a letter of explanation, but they're going to be looking at your employment history. If you are straight out of school, don't stress too much about it. That can be explained as well. But again, they do want to see a good, solid work history in your field. So chat with the lender and let's see what we need to do. Do not go purchase the washer, dryer, and refrigerator on a line of credit. Don't go buy a new car, because let me tell you what will happen if you do these things while we're in the middle of trying to purchase a house. You'll be living inside the refrigerator and you'll be living inside the car, but you won't be living inside your house. All right? Don't go and do any of that kind of stuff. The lender will be checking your credit and will pull one final credit report right before you close on the house. So don't think that 2 days before you close, you can go down and buy the washer, dryer, and refrigerator. In fact, I would tell you to wait until 1 day after you have closed on the property to go out and buy the washer, dryer, and refrigerator. Number 7, too small of a down payment. Now, ladies and gentlemen, yes, there are loans with 0 down payment. There are loans with 3.5% down payment, 5% down payment, 7%, 10, 20% down payment. The sky's the limit. So there are all kinds of loan products out there. But in addition to that, you are also going to have closing costs. All right. So you will need money for a down payment. You will need money for closing costs. All of that has to be cash that you have free. It is not wrapped up in your mortgage for the most part. So please make sure that you have a fairly healthy savings set up at this point. And if you're wondering, what does that need to look like? Let's have a private conversation and we can talk about what those numbers might look like. Number 8, a lack of documentation. Long gone are the days where you can get a loan just by fogging a mirror. Okay, you do have to have documentation. We have to have bank statements. We have to have pay stubs. We have to have taxes. We have to have all kinds of stuff. We also can't just willy-nilly go transferring money around. Grandma used to love to use what was called mattress money. And so she'd take the money out of her mattress and put it into her bank account. Don't do that. We have to source all of the money that goes in and out of all of your accounts. So talk to your lender before you do anything crazy town, but make sure that we have documentation for everything. 9, the last one, this is going to be the biggest challenge. You might not qualify for a loan or a mortgage on a specific property if there happen to be issues with the property itself, okay? If it doesn't appraise, that could be an issue. If you're looking at a VA or an FHA loan, there are certain standards of occupancy that have to be met, meaning there have to be flooring, the utilities, like the air conditioning, everything has to work properly, everything has to work. So if there are any challenges with the property itself, that could be a big deal. Another one that you might not be thinking of is if you're looking at condos specifically. Condo buyers can be denied because of HOA concerns. If they don't have enough money in reserves, if there are not enough owner-occupied units, there's a special set of challenges around condos specifically. Townhomes are a different beast, condos specifically. You guys, thank you so much for watching this video. We love having you on these. If we can ever be a resource to you, please feel free to reach out to us directly. My number and our website are on the closing screen. So please join us for another one of our weekly blogs. Jump into our social media, jump onto our website. You can find our videos there and a whole lot more. Thanks for watching. We'll talk to you later. Bye.